welcome to our webinar. Today we're going to be joined by guest Brad Hovis, and he's going to talk about real estate investing strategies, and really he's focusing on REITs, REEPs, and property stacking. So we're going to invite him on in just a minute to tell us all about those strategies, how they work, pros and cons, and we'll bring him on in just a moment. I do want to let everybody know that if you have any questions, we are absolutely taking questions throughout the webinar. Please just type them into the chat box. We do keep everybody muted so we have a nice clean recording, but if you have questions, we will take them throughout. My name is Larissa Greene. I'm with Advanta IRA, and I have been with the company for almost 12 years now. We'll talk a little bit about Advanta, and then I'll have Brad do his presentation, but I do want to let everybody know that we do not provide investment, legal, or tax advice, and all information and materials are for educational purposes only. You should always check in with your professional team, your attorney, your accountant, and financial advisor before making any type of investment. At Advanta, we do talk a lot about different rules for investing and structures and strategies that we see in self-directed retirement accounts, but please always be sure to do your own due diligence and feel comfortable with investments that you're making. As I mentioned, my name is Larissa Greene. I've been with Advanta since 2011, and I started off working sort of in the back office doing transactions for clients, coding checks, receiving income on behalf of IRAs, paying expenses for IRAs. I opened new accounts. So I did a little bit of everything prior to joining the business development and education team about 9 years ago. So I teach a lot of classes, I do a lot of webinars, and I do a lot of networking. So if you guys are interested in learning where I network, I would encourage you to send me an email or give me a call. But Advanta also has its own networking events. So if you haven't joined, I would love to see everybody join our Friday calls. They are every other Friday, and we do have one coming up this Friday, January 27th, where it's an open forum. We invite everybody to join us, talk about what they're looking for and what they have, and or just listen in. It's a great experience, and it's great to see what's going on in other markets as well. A little bit about Advanta. We are a self-directed IRA administrator. What that means is we hold retirement accounts that hold private investments. So we're not competing with brokerage firms. We're just filling the gap in the industry to hold investments outside of the market. We have been in business almost 20 years. As a matter of fact, next month will be 20 years that we have been in business handling self-directed retirement accounts. We are in the Tampa Bay area of Florida, but we can actually help anybody anywhere. Everybody that opens an account with us receives a dedicated account manager so that we can assist with any investments that you have, and all account managers are familiar with all types of investments. And so if you are going to invest in a limited partnership and then your next investment is private lending, or you're going to buy a property, maybe even invest in gold and silver bars and coins, your dedicated account manager can help you with all of those things. And I actually do see I need to update this slide. Advanta actually holds over $2 billion in assets under management. And like I said, we can work with anybody anywhere. So if you have a US-based retirement account, regardless of where you reside, we can absolutely help you self-direct that account. I think the biggest question I get around self-directed IRAs would be what types of accounts can be self-directed. And the truth is, self-direction actually, in my mind, describes the asset and not the account. So if you have a SEP IRA, a simple, a traditional IRA, or a Roth IRA, all of those can be self-directed. And that also includes health savings accounts and education savings accounts. We can also help you with a solo 401k. And so if you guys have questions on any of these types of accounts, please feel free to reach out to me, because we actually do have webinars dedicated to learning about the accounts and maybe what type of account would be right for you. But I'm also happy to answer any questions on that as well. And so a lot of times people say to me, well, I don't have a Roth IRA, so I can't self-direct it. I can't buy real estate if I don't have a Roth IRA. I'm not really sure where that comes from. But the truth is, any type of retirement account can be self-directed, with the exception at times of your current employer's plan. So if you're like me and you work for a larger company, you have an employer plan through that company, they can restrict, and often do restrict, the movement of those funds. And so you would just have to check with that employer plan to see if you could move money from that account over to an account with Advanta in order to self-direct it. The IRS has always allowed alternative investments in an IRA account since the beginning of IRAs back in 1974 or 73 when they started. And the truth is, you may not have heard of self-directed retirement accounts just very simply because there's not a lot of companies out there like Advanta that are willing to hold these types of accounts. Brokerage firms don't really want to receive rental income, for example, on behalf of a retirement account. They don't want to pay expenses for that rental. They're not sure how to code interest income from private mortgages, and they also don't know how to value those. And so we really just are specialized in those types of accounts for those assets, and so we certainly can hold them. And actually, we've made it a business decision not to hold anything inside of the market, so that is where we're just really filling the gap, and we can help you truly diversify your portfolio. The IRS does have two asset classes that they don't allow. They don't want to see you investing in collectibles or insurance, but outside of that, the sky is just about the limit, and there are some other rules that you should be aware of. But just to keep moving the webinar forward and to get to speaking with our guests, I'm just really going to give you an idea of the things that we see on a pretty normal basis at Advanta. Real estate in any kind. We can hold long-term and short-term rentals. You can invest in mobile homes and mobile home parks, single-family homes, duplexes, multifamily investments. You can invest through limited partnerships and syndications. You can lend money, whether it's a first, second, third mortgage, or even an unsecured note. We do see a lot of private placements, people investing in local breweries. We have clients invested in things like wineries and restaurants. We have clients invested in private stock through like private banks. And so the list really truly does go on and on. Clients can hold precious metals, whether it's gold and silver bars and coins or other types of precious metals. We do see foreign currency exchange and futures trading. And as I said, the list does really truly go on. We have a whole webinar dedicated to the unique investments that we see in a self-directed IRA. I've had clients invest in racehorses, cattle, alpaca, just to name a few things, and just keeping in mind that you can really truly invest in what you know best when you have a self-directed retirement account. And I think really that is the best thing about a self-directed IRA. So we're going to talk today with Brad about real estate. So I wanted to just very quickly again go over the different types of real estate investments that we see. And there's no requirement actually that the IRA even have income. And so we have clients invest in things like raw land or vacant land, or they even buy empty fields from farmers and they lease them out. We've seen people lease to hunters and campers and things like that. So our clients are really truly creative. But if you're going to do some land speculating, for example, you certainly could do that, and there's no requirement that that investment has regular income. We have clients very, something that's done very commonly is investing in single family homes for long-term rentals. But of course, we're seeing more people with interest in short-term rentals and rehab projects. It can be a condo, and I mentioned mobile homes and mobile home parks. We also have people invest in tax liens and tax deeds. And so I'm not sure where you might be located, but in the state of Florida, we're coming up to tax lien season, as I kind of refer to it, where people will have the opportunity to bid on tax liens, and you can certainly make those investments in a retirement account. I think that's a neat investment because it doesn't take a ton of money to invest in tax liens, and then certainly tax deeds as well. Real estate investment trusts, syndications and private placements, commercial property, and multifamily, as I mentioned earlier. So those are the very common investments in real estate that we see. And then there's some unique ones as well, like options in real estate. But I won't go on and on because I certainly could, but I hope that everybody will join us for another webinar where we talk more specifically about the investments and structures of deals in IRAs that we have seen. And so now I'm going to turn it over to Brad Hovis. He is going to teach us about REEPs, REITs, and property stacking. How are you today, Brad?
I'm doing well, Larissa. Thanks for setting this up.
Yes, absolutely. And before I give you the reins there, I just want to remind everybody to please keep in mind that we will take questions throughout the webinar. You are welcome to type them into the chat box and we will get those questions answered.
Wonderful. Yeah, again, thanks. Larissa, Advanta has been great to me and some of my clients over the years. My name is Brad Hovis. I'm the CEO of Rollover to Retire. We're a real estate investment company. and specializing in REEPs. Now, this is kind of a new term that's coming out, and I really want to kind of get into it. But before I get into what a REEP is, I want to get into the reason this investment strategy has even come to fruition. There's a problem, and there's a problem among real estate investors, and there's a problem among those of us who hold self-directed funds that I really think a REEP, which stands for Real Estate Equity Partnership, can really help. And the problem is um, finding deals. Uh, we're really not interested in finding properties. Like as an investor, properties are all over the place. You're not looking to buy a property typically. You really want to be buying a deal. As I tell my sales guys all the time, if all I was looking for was a property, I would go on the MLS, make a few offers, and I wouldn't need them. But what we're looking for are deals. And so that's the problem for us investors. We don't want to necessarily pay retail, particularly right now when we don't know what's going on in the market. Is it going up? Is it going down? We don't know what's going on. However, as investors, if all we're ever doing is entering into real estate products and real estate with some equity, then we know that we're getting into a safer investment. We know that we're getting into something that might be able to make us some money down the line. And so, as we're dealing with real estate investing in general, the problem is finding deals, particularly to invest our self-directed funds in, because not only self-directed funds, but 1031 exchanges and all those sort of things, there are some restrictions and limitations that I really think that REEPs help us with. So let's get into that. Real estate is great again, but where do you find deals? Typically, where you're going to be finding deals is from some kind of source that you've, found yourself. Realtors, wholesalers, referrals. Someone you introduce yourself as an investor. You try to find deals from different kinds of people around the real estate industry. You'll go on the MLS. You'll look at properties and hope that what you're acquiring meets the definition of a deal for you. Now, there are other places to look for deals, and those are in funds, things like real estate investment trusts, private equity, and those sort of things. I'm going to camp out here just for a little bit. Yeah, a real estate investment trust, of course, is publicly traded. Private equity, hedge funds, those sort of investments are done so under some pretty strict rules and done under a lot of different kind of strategies, typically with much larger projects, i.e. apartment buildings, commercial buildings, those sort of things. Among all of these strategies, what you have are pooled funds where investors are pooling their money together in order to then use that as effectively a down payment or even an operational reserve that then gets leveraged against the property. Okay. Where REEPs are a little bit different, of course, is that there is no debt associated with the investment. We're going into a unique segment of the country, a unique area that makes it so that our acquisition price is much lower. Therefore, we don't need the banks typically, and we are, acquiring at a steep discount because of what needs to be done to the property to get it up there. Now, before I get going, again, I'm the CEO of Rollover to Retire. We've done over $55 million worth of deals. We buy properties across the country, primarily right now in Memphis, Tennessee, and we've been doing deals for over a decade. And I am an investor as well. This is why we kind of carved out this category to help investors with that major problem, which is finding deals. So let's get into it. I don't know if the slide right now is working. Larissa, there we go. So what is a real estate equity partnership? Simply put, it is Investor capital is being used to acquire single family homes at a discount in cash flow markets. That's a big key. Now, there are different types of markets uh, across the country. The major two categories that we like to discuss is cash flow markets and appreciating markets. Appreciating markets would be markets like Denver, Seattle, San Diego, markets that typically see a a a rise in property values. Cash flow markets are more middle America. Markets like a Memphis, St. Louis, Kansas City, Tulsa, Jacksonville would kind of count in that category, because those markets are not, known and attract investors to them because of their appreciation. They attract investors to them because of their cash flow, the ability for their the price to rent ratio being far more attractive, meaning you can actually, for an example, I live in Denver, but I do deals in Memphis, and in Denver, the average, rental property, single family house is going to cost me $500,000, and I'll rent for about 2,500. Whereas in Memphis, I can go get 4 or 5 houses for that same 500,000, and my rent will be closer to $6,000. And so if you're looking for that cash flow and that wealth build, you'd go into a cash flow market rather than in Denver. Hope that makes sense to you. And so what we do is we find these deals via a ridiculous amount of marketing, everything from, direct mail, SEO, PPC, billboards, bandit signs, cold calling. We don't do text anymore because of the FTC, I believe it is. But we would send courier pigeons if we could to find these deals, because what we're really trying to do is find properties that we can add value to, so that we are entering into the investment with equity. Equity is what makes it so that we have a seat at the table with our investors. It makes it so that, frankly, it's a much more safe investment. Now, that is in essence what a REEP is. It's the capital investment. Because the capital investment is relatively low, we're in these cash flow markets. It's typically less than $200,000. Loans and banks are prohibited. This is the reason. Banks really eat through the cash flow, and loans really eat through that cash flow, making it a difficult investment. So what a REEP does is hold these properties long term and allow equity to increase. And what we've seen over the last, 5 or 6 years investing in a market like Memphis, we have actually seen appreciation. Though we got into the market because of cash flow, saying we want to be able to double or triple or quadruple sometimes our cash flow moving from one market to another market. We have seen the equity increase. And why do we see that? Well, because our government keeps printing money, and we continue to see loans being pushed towards the real estate world. Not right now. Right now things are a little frothy because of high interest rates, but the values of these houses have continued to gone up while we sit back and just cash flow. That's the essence of a real estate equity partnership. That's the essence of a REEP, to let the equity continue to grow as you hold on to it long term. The reason it's really called an equity partnership is because you are indeed in partnership with a REEP manager and an investor. The equity and the cash flow is then split among both the partners. See, as opposed to other type of investment vehicles, the REEP manager sits on the same side of the table as the investor. They don't make money until the investor makes money. Going back to my examples of private equity, a lot of times when you see a lot of these funds getting put together, you have an acquisition fee of 1%, you have a yearly management fee of 1%, and then you have a disposition fee of 1%. The investor will get a 6% preferred return at the end of the investment. And what they're hoping to do is then chop up the equity 80% to the investor, 20% to the fund manager. And so the complications of that, and frankly, what we see a lot of times in REITs and private equity is that 80-20 split on the backside never really happens because the manager has effectively eaten up a lot of the profits in the operation of it daily. This is where REEPs are different than REITs. This is where REEPs are different than private equity, because with an equity partnership, you're on the same side of the table, and I'll get into that a little bit more. So why use a REEP? Okay, there's no pooled funds. It makes liquidity a lot easier. Oftentimes, when you're talking about these larger investment vehicles, what you have, and you've heard these advertisements on the radio, hey, show up at this hotel ballroom. We're going to get all together. We're going to explain, here's this 500 unit apartment building. And what we're looking for is $100 million that we can then go and leverage and go buy a $400 million apartment building. And that all sounds fine and good. And the presenter says to the investor, you're going to get a 6% preferred return, meaning whatever the cash flow comes out, the first 6% are going to the investors. And then after we have held this thing for 5 or even 10 years, we'll then sell the investment. Whatever profits we've made, we'll then split 80% and 20%. And on the surface, that looks really, really good. But the problems that no one really thinks about are the fact that you have pooled funds all together from other people, and in order to unwind those pooled funds, sometimes it's completely prohibited. You can't get your money out until the investment has come to the end of its life cycle, meaning until they've sold the property. That can be problematic if you are in a position where you need to be liquid within a relatively quick amount of time. We'll talk more about what that liquidity looks like later, but because there are no pooled funds, liquidity is easier. And the reason there are no pooled funds are twofold. One, we're targeting lower priced properties, therefore making it a whole lot easier to be able to have one investor, typically, sometimes two, but mainly one investor fund the entire deal. The second reason there are no pooled funds is because there are no banks, there are no loans against the property. And the reason there are no loans is because that loan will eat away too much at these lower valued, lower rented returns. And so it's a pretty relatively safe investment compared to other private equity or REITs or those types of large investment vehicles. So a REEP doesn't involve pooled funds. It also doesn't involve it involves one decision based on one property. And so because it's the structure of a REEP is one investor with one property, the investor is having to make one decision, which is, does 123 Main Street work for my investment objectives? You get to decide. Whereas when you pool funds together, oftentimes a private equity company is pooling funds and then considering several different options. They may be thinking about an apartment complex in Florida or a commercial building in Georgia or anything in between, or West Coast or East Coast, and have given some vague generalities that will then get tightened up around the actual deal. But REEPs make things a whole lot more simple. A property is presented to an investor, and the investor gets to say yes or no, because these are lower priced investment vehicles. No, of course, no tenants and toilets. Management partners handle it all, so you're not having to worry about that. The biggest issue, and this is the reason why I like to not only run a REEP business, but I like to partner with other investors using this REEP strategy, is because I know that our interests are aligned. I know that there is no conflicts of interest. And yes, you can paper as much as you want with these larger equity companies, but at the end of the day, they're running a business just like everyone else. And so some of those issues get ironed out, knowing that I'm just sitting on the same side of the table as these managers. That partners have aligned interests because the profits are what are distributed, both the equity and the cash flow. An investor puts their money in, and what comes out is either cash flow or equity, and that gets divided. We'll talk about that in just a second. This is part of the reason why I'm here today, is the ability for third-party involvement. It meets self-directed 401k and IRA requirements. It's compliant with the SEC. It is a securities offering, these REEPs, and it makes it so that all of the requirements inside self-directed are being met, because you're not having to deal with the actual investment and those sort of rules and regulations. You're able to get properties at a discount that need to get fixed up, that can then add some equity to your portfolio and not have to deal with it yourself, which is very good from a compliance standpoint. It's a simple transaction, typically a checkbook, self-directed IRA, or cash that gets sent right to a title company. There's no submitting funds and waiting for a closing to happen several months later, like with other REITs and not necessarily REITs, but mainly private equity companies. And so the control is still there. The control is still in the hands of the investor. It's a simple transaction to fund a real estate deal right with the title company. And you get to invest in a deal. I can't stress that enough. This is the problem that is being solved. A lot of these investment vehicles are just buying properties at retail. And when you buy as an investor properties at retail, you're not really investing, you're more speculating. You're hoping that the market goes up. Well, by definition, as an equity partner, there has to be equity in the property to begin with. And so by definition, you are investing in a deal. How this is compliant with the SEC, by the way, is with a private placement memorandum with accredited investors. So let's look at a case study. Enough of the technical jargon. Let's get into the deals. And these are
Hey, Brad,
things that, yes, go ahead.
before you go on, I had a question about how investors, when they're looking at or doing their due diligence on REIPs with partners, what would typically be the structure of this deal? So like, if somebody approaches them and says, hey, do you want to invest with me? We're going to, structure it as a REIP. What does the structure look like that? And you kind of mentioned at the bottom of that last one that it's a private placement memorandum with accredited investors. Is that typically always how it is? Do the investors, when they're working with a general partner, for lack of a better term, are they going to be looking for their name on the deed, or how does that work for a REIT?
Very good question. I was going to get to it later, but I'll get to it right now because I want to make sure I address that. There are a couple of ways to do it. There's the friends and family way to do it, and then there's the non-friends and family way to do it. The friends and family way that I recommend, and that my securities attorney has recommended, is that you do a 506, that it's a private placement memorandum with a 506B exemption, which is for friends and family, people that people that you have a barbecue with, your next door neighbors, people you go to church with, whatever it might be. Those are the types of people who can invest in your REEP, okay? Or that if they have a REEP, you can invest in, and you don't have to be an accredited investor. If, however, you find someone like me on this webinar, and we don't know anybody from anything. And the reason you've come in contact with me is because you saw uh, me teaching on REEPs or at some real estate investment club or picked up my book or whatever it might be. Then you would need to do, again, a private placement memorandum with a 506c exemption, which is just for accredited investors. Now, a lot of people don't understand what an accredited investor is. An accredited investor is someone who has a net worth of $1 million outside of their primary home, or make $200,000 a year themselves, or them and their wives make $300,000 a year. Now, there's a whole bunch of other things, but those are the top 3 categories for accredited investors. That's the SEC compliant way to do it. That's the way I would recommend doing it, and that's the way I would. That's the way that keeps everybody super safe. Okay. The way I don't recommend it be done is just 2 people coming together and saying, "Hey, let's partner on this deal." Okay, that gets a little sloppy. The Securities Commission, depending on how the deal is structured, the SEC could have an issue with that, particularly the way that we do it. Our investors are investing in the asset, and we're just doing the management side of it. And so we don't have, quote, capital skin in the game. We have human resource skin in the game, but the SEC doesn't count that. So it's very important that when you do a REEP or involve yourself with a REEP, that you're not going cheap and that you're not being sloppy with it, because what can happen is you can have some issues with the SEC, and that is one area you do not want to have issues with. So that's the back end structure. Now the front end structure, and that is a private placement memorandum with an LLC, and an operating agreement. Both that private placement memorandum and that operating agreement is incredibly important as far as the SEC is concerned. And so you want to make sure that everything is papered correctly. It is more expensive if you just decide to do one off with a buddy of yours. But we have a lot of people who come to us primarily because we've already worked out all of we've done the brain damage already. But if you've got a friend that you'd like to do deals with, my suggestion highly, and I think a lot of real estate investors get a little lax on this, is to understand exactly what's being done. Now, notes are completely separate. Like if you were to borrow money from someone, that's a completely separate deal. That doesn't necessarily, from what I understand, I'm not an attorney, I'm not a tax expert, I'm not giving legal advice, I'm not giving tax advice. That's not necessarily a securities issue. But the structure of the deal is that the investment company partners together and then acquires at least one property, but that investment group with that private placement memorandum can acquire several more without having to do additional paperwork. So I hope that answers the question, Larissa.
Yes, that was a great explanation. Thank you.
Okay, great. So now getting to the good part, the deals. This is what gets me going as a real estate investor. This is a property in Memphis. It's in a B neighborhood. We acquired it for $85,000 and needed about 30 grand in both rehab, reserves, and closing costs. I'll get into that in just in a second. At the time, it was worth $115,000. We actually bought this last year, so it's the market value. I haven't done an updated market value, but I would bet that it's worth more now. But we entered into the investment being worth $140,000 and it rents for right at $1,400 a month. So instant equity of 25 grand. And this is a pretty typical deal where the REEP manager, effectively what you're looking for is the REEP manager, whether you're working with us or anybody, that when they're bringing you a deal, that they justify their position in the deal, that has enough equity for you as the investor and for them. The reason you want that, and like I said, I invest with other people as the investor in a REEP. I also run my own thing, but these are my operation is in Memphis, but I invest in San Antonio and other places. What I want to make sure is that it's a clearly defined relationship. I want to play sometimes I want to play the white collar role where I just put up the capital. Sometimes I play the blue collar role where I put up the human resource and I bring the actual deal and I handle all the blue collar type work. And so what you want to do is number one, make sure that manager is justifying their position in the deal by getting a good enough deal. As far as I'm concerned, a B neighborhood that rents for $1,400 a month, that I'm all in 115 grand, and I walk into the deal with about $25,000 worth of equity. Yes, I've got to split it, and I'll get to the splits in a second. That's 75% to the investor, 25% to the manager. I'm turning my 115 into about 130 and some change on day one. See, that makes it so that, hey, REEP manager, you brought me a deal that's good enough for me to say, yeah, this is going to work. See, that's what a REEP does. A REEP makes it so that you are able to enter into an investment with instant equity. Let's look at another one. This is on Fox Ridge. This is a B plus neighborhood, a little nicer. Bought this for 111. Rehab reserves and closing costs 19,000. This is before we did any rehab on it. All in 130. It's worth 160 when we bought it. So the instant equity there again is now $30,000. It's a nicer neighborhood. It's renting for that same about $1,400 a month. But those are the types of deals that I like to see and I like to do. Last case study, and then we'll get into some other stuff. This is a really nice area, B plus, A minus type neighborhood. Acquired it for 125, all in 150. Market value is 175 at the time that we acquired it, and is renting for $1,600 a month. So a little bit less on the equity compared to my all in 25, but I'm getting higher rents at $1,600 a month, which means my cash flow is larger, and that comes in handy when I start talking about property stacking. So now let's look at what it looks like. Part of the reason why that manager is able to justify their position is they're creating equity with their ability to rehab houses. If a typical seller takes them $40,000, $50,000, $60,000 to rehab a house, and a manager can get it done for $15,000, $20,000, $25,000, they have created instant equity that they get to participate in as I, the investor, fund the deal. And so it's a win-win for the both of us because they're working for their equity and they're providing me an investment opportunity that makes things really attractive. And so you find a house beat up on the left, fixed up on the right, putting in a new kitchen sometimes. You know, this is a more basic kitchen, pretty standard type stuff, before and after pictures, where we're taking houses that we're able to get at a discount because of the rehab issues, and then doing the problems. So not only do we enter into the investment with equity, we also are able to get more. But wait, there's more cash flow. Besides equity, REIPs have a second profit source, which is cash flow. And I would, in my opinion, I'm a cash flow kind of guy. Cash flow is far more important to me than equity, but they're equally important. You need both equity and cash flow. It's different sides of the same coin. So besides equity, we have a second profit source of cash flow. Cash flow keeps the investment in the game for equity appreciation. Houses that we bought in Memphis back in 2017 that we were all in for $70,000 are now worth close to 200. And we know that there's been a write up over the last 5-10 years here. that's what cash flow does. It allows you to stay in the game, continue to make money, and allow the market effectively to come to you. See, these are the types of deals that gets me excited when I'm looking at properties that we bought for instance, even these case studies. I've been showing these case studies for a year now. I would surmise that they've gone, had a 10-20% bump. And so as we're looking at that, this equity appreciation is significant. Cash flow also builds wealth. Remember, passive income larger than monthly expenses means that you are wealthy. You no longer have to work. And so when you're holding these properties long term, that's helping you towards that wealth formula. As more cash flow is distributed, an optional new strategy can emerge, and this is where it gets really exciting, particularly for those who are investing in real estate and think to themselves, I don't want to deal with tenants and toilets. I just want to invest my money into a commodity that everyone is going to need, i.e. housing. And it's called property stacking. So let me get into property stacking real quick. Property stacking is a strategy used to allow real estate portfolios to produce its own investment property without any outside capital. That the portfolio itself starts to give birth to these golden geese. That the portfolio itself is able to generate enough cash flow that as you are working your regular job, you kind of just allow your portfolio to reproduce itself. Simply put, the cash flow from your portfolio could be used to buy more property without additional funds. Dave Ramsey talks about the debt snowball. This is the wealth snowball, property stacking. And so as more investment properties are bought, the cost to buy more is decreased because the cash flow is helping fund future acquisitions. Basically what we're saying is, rather than taking that cash flow and go and spend it, take that cash flow and reinvest it. You hear about business owners always reinvesting in their businesses. For some reason, real estate investors have this mentality that once they get that money, they don't want to reinvest it in their business. But for those of you using self-directed funds, reinvesting that capital is a normal thing because most people can't access those funds until after retirement. And so you can download a calculator with a video that explains this at our website, rolloverretire.com/calculator. This calculator will make it so that you can plug in a few numbers based on whatever market you choose, and the numbers that are typical there, what the appreciation is, what the average market value of the houses that you're buying, or what your all-in amount is, and how much the rent would be. Typically, I like to use the 1% rule, which is if a house is worth $100,000, it'll rent for 1%, because that helps. You can buy those deals in several markets. I've actually identified 19 markets that I think REEPs work in. They don't work in Denver. They don't work in Phoenix. They don't work in New York City. They don't even work in Miami. I'm not sure they even work in Tampa, Larissa, but I think they do work in several markets, like a St. Louis or a Kansas City, Tulsa. Cleveland is a good market that I think that REEPs work in. So whatever market you're in, download that calculator, hop in there, and go to town. It'll teach you how to figure out at what point in your portfolio's life history, or how many years it's going to take before your portfolio can start producing its own rental property. So let's give an example. Let's pretend you were able to buy one investment property per year and you just stacked the cash flow. Average all investment 100,000. This is just for purposes. We're assuming that it appreciates 3% in both equity and cash flow every year, and that we have a property that we're getting $600 a month in. Okay, that's $7,200 a year. So year one, we only have one property, $7,200. Okay, we've paid $100,000 for it. $7,200 is our cash flow, and now instead of spending that cash flow on vacations or whatever else, we just stack it for a couple of years. Year two comes to $14,000 because we bought an extra property. We're adding the cash flow from the first one, cash flow from the second one, and now it's $14,000 $832. Year 3, $22,000. Year 4, $31,000. Year 5, $40,000. After 5 years, you have cash flowed $116,000, which is enough to buy another deal. Now, that's if you used all of the cash flow. But where property stacking becomes really attractive, which is where, I'm at and several of our investors are at, is the annual cash flow alone is able to produce. If my cash flow come year 12 is over $100,000 and 100 and some change, then my portfolio can acquire a new investment property every single year without me doing anything else. And this is where REEPs really help with that. We just, as investors, allow our capital to do all the work for us. So that is a pretty powerful thing to allow that wealth snowball to grow and grow and grow.
So we did have a quick question, and I think you kind of went over this in that you're talking really about holding properties long-term, but we did have a question on the difference between a REEP and, like a flip house. And I think it's based on just, the term of the hold, but maybe you could go into that a little bit.
Yeah, so a fix and flip is where you buy a house, you fix it up, and several months later, after you've bought it, and hopefully as soon as you're finished with the fix up, you sell it. You put it on the market and you sell it right away. That's a great strategy when everything goes exactly right. Meaning, and I've flipped over. I flipped over 100 and something houses myself here in Denver. So that's a short-term flip. Now, what we have done in this REEP category is what we call turnkey flip. So a fix and flip, you buy it, you fix it, and you're typically selling it on the market to a first-time home buyer. Okay. But some of our investors have said, no, you know what I want to do is buy a house, fix it up, hold it, and then sell it to a turnkey buyer. Whereas fix and flip is selling it to a retail buyer, someone who's going to live there. A REEP strategy that could work with flips is that you're selling it to a turnkey buyer. Okay. The part of the reason why fix and flips don't work as well with REEPs is because of some SEC issues, according to our securities attorneys. And so holding it long term is a safer play from a security standpoint for the manager and for the investment in general to go in with that rather than a short-term fix and flip mentality. Sometimes things don't go well in a fix and flip. If things don't go well in a rental property, you just keep holding it. If things don't go well on a fix and flip, particularly if it's leveraged, yikes. In fact, what you're seeing right now, I don't know what part of town you're in, whoever asked that question, but what you're seeing right now is there's a lot of fix and flippers who are getting caught in this market frothiness. And I hope that the market continues to either flatten out or go up, but there's a lot of properties on the market that are getting some price reductions and have had for the past 3 months or so. I'm not sure that's going to continue long term, but it may continue short term. And if your financing is short term and difficult, you may have a problem. So that would be what I would say is the difference between a REEP and a traditional and a fix and flip. Can you partner on a fix and flip? Of course you can. REEPs are really designed though for more long-term investing.
Okay. And then we had a question. Well, we have a few questions on how the investment is made. There was one question on the math, if you could just go over that again. I think in your blurb above, it does say that you're allowing 3% appreciation on cash flow as well, meaning that you're assuming the rent is going to go up every year. Is that correct?
Correct. Yes. I tell my tenants ice cream melts and rent goes up. So every year in March, actually, we raise our rents, and we call it March Madness because that's when some of our tenants get mad at us. But I've got to keep up with. I'm a business. We're a business, and as long as they continue to print money and as long as inflation continues to go up, so does rent. And so you have to factor that in to your equation. However, if you didn't want to, you could just go 7,200 times 2, and that would be 14,400 instead of 14,832. So it's increasing 400 something dollars on year 2, and then it kind of snowballs from there. But what this is assuming is buying one investment property per year, which in my book I go through the entire plan for how to buy one investment property at a discount with cash every year and hold it for the rest of your life, and how fast you're able to see wealth being created, and how the first house ought to be your hardest house. Because one strategy, again, in the property stacking side, is that if you paid 100,000 for this first house and can pay 100,000 for each house in these cash flow markets, if you just took the cash flow on year 1 and applied it to the second house that you buy, now you're paying 90, well, a little less than 92,800, so $93,000. Now the next one is going to be 14,000 less. The next one's going to be $22,000 less eventually as you get going. And in that calculator, it really shows the least amount that you have to keep putting in. But you got to get started. You got to buy that first one and then try to commit to buy that second one and then that third one using the cash flow that's already been created. My purpose in showing this 116,000 was that, hey, don't spend the cash flow, reinvest the cash flow, stack the cash flow, and eventually, if you download the calculator, you'll see something like, I want to say it was around the $400,000 mark is the total amount that you would be putting in over the course of 12 years from outside capital, and that 400,000 turning into $10 million worth of real estate 20, 30 years from now, 30 years from now or so, when we're at retirement age. And so that's the equity side of it. That's the cash flow and the equity side of it. But it's also the wealth building side of it. We talk about, this was a concept, frankly, that I needed to hear as I was talking to investment bankers. And they talk about this investment compounding and compounding and compounding. And I just couldn't get my head around, well, wait a second, the stock market goes up, the stock market goes down. Yeah, I have an average annual rate of 8% with S&P or whatever it might be, but how do I know that it's going to happen? Like if I bought it at the high part of the S&P and then I'm retiring at the low part of the S&P, it's not really 8%. So I had to get my head around it. Well, property stacking was the way that I could get my head around it. I go, oh, I just reinvest the cash flow. Oh, that makes sense to me. So that's the math on the property stacking, but more of that is actually found again in that calculator, in the video with that calculator to help you with it.
Okay, and then we did have another question pop up about what's the trigger that when to actually cause a property to be sold. So when is a property sold and what triggers that?
Great idea. So all REEPs are different, but the way we've structured ours is we have to hold it for at least a year. Okay, and the reason we do that is we're acquiring a distressed property at a discount, fixing it up, putting a tenant in there. So it takes time, typically in the, hopefully, 2 to 3 months, but sometimes it can last up to 5 or 6 months. And so we don't want to rush that, right? We don't want to then, and that's assuming that we acquire it vacant, right? Sometimes it has an occupant that we have to get out of there, so that adds more time, particularly if they're a non-performing tenant and we have to process evictions. So the timing to get the investment going is an issue, and I go through that later in the presentation. But the trigger whereby someone can say, hey, I'm out, I want to be done with this REEP is on an annual basis for us. So come January 16th, which is my birthday, I always tell people, just let us know if you want to do one of three things. One, keep going with the investment. Two, sell it. That's when my team will go and we'll try to sell it for as much as we can, typically to a turnkey buyer. Or three, buy us out. And so this is how we structure it. Other people structure it a little bit differently. How we structure it is a buyout is we just go get an appraisal from a third party. That's the top end value. We subtract whatever the investment was. So for instance, if someone put in $100,000 and the appraisal comes in at $140,000, that means that there's $40,000 worth of equity. My company gets 25% of that equity. So our investor would write a check to us for $10,000, and now we're 100% out of the game. Okay. So every year we give our investors an option as to whether or not they want to keep it, sell it, or buy us out. That's how we've structured our REEP, and it's worked out really well that way. Sometimes though, local markets change. Like for instance, Detroit didn't happen overnight. You know, that's a market that you started seeing for decades. And so there's been occasionally where we've bought a property that was in a great neighborhood. We only do B and C type neighborhoods. Other REIPs are like, they like to deal with, far more distressed D and F type neighborhoods that are more rough. But we like to deal in just B and C neighborhoods. The cash flow is good, the headaches are low, but the property still appraises or still appreciates, and we're in good shape. But sometimes the neighborhood starts to not be as good as we hope for it to be. Once we see signs of that, as a manager, we come to our investors and say, hey, this neighborhood's not working. I think we need to unload it. And most of our investors, because we're the local experts, say, yep, let's do it. Let's get cash out and let's get into a different place that we think is going to work better. So most of the time, go ahead.
So, sorry, Brad. So that would be something that when people are looking at a specific REIT they want to get involved in, that's probably a great question, right at the outset. What is the exit strategy for me as the investor? How long do I have to commit to this investment before I can make a decision on when I want to leave it? Like you said, I think all REIPs are going to kind of be different. So maybe or would that be typically something they could find in the paperwork when they're making an investment?
Oh, that'll absolutely. It had better be in the paperwork.
Okay.
The SEC requires that. So
Okay.
because of that exact reason, because you want to know how long, am I stuck in this thing for forever? Like how can I get back out? And this is where one of the differences between REIPs and private equity companies are. Private equity companies have very strict get out clauses, 5, 7, 10 years. You can't even touch it. You can't even ask for it. It is very, and rightfully so, because you're dealing with large amounts of money and large amounts of risk, and there's a lot of stuff going on that they don't, and a pooled group of funds where there's hundreds even investors in one single deal, and you wouldn't be able to make it work if 20% of them kept asking to get cashed out. And so if you're in a REIP, you want to make sure that is clear, that is, but typically you're going to have at least a year. A year is pretty typical. I don't do anything that is less than a year, because what I don't want to do is get stuck in the middle of a rehab and an investor saying, hey, we got to get out of here. That's how we have problems all the way around. And we're trying to avoid problems. We're trying to make sure that we're making money, not losing money. And so that's a pretty standard exit strategy. But yeah, Larissa, that's a great question to ask. Anytime you're getting involved in that, you need to make sure you understand the exit strategy.
Okay, great. And then I had another question pop up about leasing the property to a friend or family, and I'm going to start with answering from the IRA side. For the asker, just keeping in mind that if you're investing with an IRA and partnering into an investment property, that you're aware of the prohibited transaction and disqualified persons rules, that you're not leasing that property to a friend or family member, or excuse me, to a family member or even a friend that might be considered a disqualified person, depending on how you're related to them. So that's going to be super important. And then I'm going to let Brad answer from the investor standpoint. So leasing to a friend or family.
Yeah, I mean, that we buy from sellers who lease to friends and family because they have to buy at a discount. Sometimes I think I'm not a real estate investor. I'm a family counselor where I'm buying from a seller who doesn't want to evict, their niece or their brother or their mother or whoever, but need to get out of the investment. And so I come in, buy it at an incredible discount, and I'm okay to evict them. So if that's a strategy for us when we are acquiring, why would I want that to be the types of tenants that we deal with? No, no, no. We don't. We're a professional management company. We deal with individuals who are qualified and only that are qualified, and that we're not going to have any headaches with, or perceived headaches with in the future. So no, we don't lease to friends and family. There's not much good that come from it, frankly. So.
Mm-hmm. Okay.
But the disqualified persons thing is a big deal for self-directed funds, meaning
Mm-hmm.
working with the REEP, they're not disqualified people. They're not your family. They're not whatever. This is part of the reason why a lot of self-directed investors work with us, because so long as they see the product, see what is happening, it meets all the qualifications for self-directed, and makes things a whole lot easier on that back end. So.
Another question we had also is the investor versus the general partner. Are they bringing all of the money to make the purchase and do the rehab? Because I know you said that there isn't really financing in this strategy, and so if a property is 100,000, is the investor coming to the table with 120,000 to cover closing costs and all of the rehab expenses? How does that typically work, or is it on a case by case basis?
Well, how we do it is pretty standard. Some guys will put in their own capital, but then I think it muddies the water. I think you have two roles in a REEP. You have the white collar side and then the blue collar side. And so for us, the investors putting in, all the capital, they're putting all in all the financial capital. I'm putting in the human capital, right? Because I've got a staff. We have, um, a lot of people that work. We have crews. We have, you know, salaried people that we're continuing to use for our business. And so typically that investor is putting in all the capital, but they'll get that all-in number. Just because we buy it for 95, we tell them that we're buying it for 95, but we're always talking about the all-in price, which is typically about that $120,000 range. So.
And so does that mean that there could be a capital call and a request for more funds from the investor during the investment process, during that rehab process for unforeseen, expenses, or is there typically some sort of, backup amount included in the total investment request?
So that's a very good question. Two things. One, we haven't had a capital call, knock on wood, in 4 years. And we pride ourselves in that because we want to overestimate the rehab on the front side. Okay. But then the second answer to that is included in that all-in amount is about $3,000 to $4,000 worth of maintenance reserves in case a furnace goes out, or air conditioner goes out, something happens. And the third answer to that is every month, part of the rent expenses or the rent costs that we're taking off. I've got a slide that kind of explains the numbers a little bit more. We're accounting for all the maintenance that is uh, that we're anticipating for the future. In fact, I did a huge study of my own portfolio, which is hundreds of houses over the course of the last 10 years or so. And I looked at previously and I looked at just here over the last 4 years, and I came to the conclusion that per house, per property, regardless of occupancy, and regardless of what the rent is, it has cost me 120. Actually, it was like $121 per property per month, regardless of occupancy. And so what we do is we take out $125 off the rent every single month and put it aside in a maintenance reserve, because just because we're not changing out a furnace this year doesn't mean we're not changing one out next year. So yes, the answer to that question is depending on your operator, yeah, you might have a capital call. Luckily, we've been able to avoid that because I mean, we've been doing it so long. So
And would that also be something in their investment paperwork with their operator where it's clear that if there's a capital call, there's a cap or an amount or a time when that capital call would be requested? Or is that something that investors need to be aware of and say, okay, in the event that you need additional capital, how does that work?
yes, it's all in the paperwork. It's pretty. That's also required, I believe, by the SEC. I don't know if it's required by the SEC, but we definitely put it in there because I don't want investors having capital calls. I use the same paperwork when I do a REEP. So that means I don't want a capital call. You know what I mean? So what I want is, and luckily for the past 4 years, uh, and even 4 years ago when we had one, it was a rotted out. I remember it like it was yesterday. It was a rotted out floor that someone had put fake floor on top of that we couldn't see. But once we had some plumbing issues, we realized, wait a second, this entire bath is about to fall through through the flooring. So we had to. It wound up being about a $4,000 capital call, but that was the last one we did about 4 years ago. So
Okay. Okay.
very important to maintain reserves, and that's why we produce this paperwork, which is later in the presentation, where I show where all the money comes in and all the money comes out. Because at the end of the day, our investors are to do one thing, and that's invest. The rest of it is to collect checks. That's the next option for them, and that's how a REEP ought to go. Is they put in their 120 and they get their cash flow every single month. So
Okay, and I do see a few more questions, but guys, we're going to keep moving forward. I appreciate the questions. These are great questions, but we are running over, so I want to get to the meat of the presentation, and then we'll see if we can take a few more questions afterwards.
yeah. So that's examples of property stacking. Larissa, I think there we go. REEPs are perfect for property stacking. I'll fly through this a little bit. REEPs find properties at a discount that can actually cash flow, increasing investment. REEPs allow investors to sit back and do what they do, invest, like I said. REEPs aren't fee-based property management. That's a big deal. That's a big deal. If you actually start adding up, because we're partners, if you start adding up what typical fee-based property management companies do, that 8 or 10% monthly fee is not the total amount that you're paying on an annual basis. Even to lease up the property or to renew a lease or to, for maintenance calls with markups and all that kind of stuff. REEPs aren't sitting on the same side of the table as the investor. Yeah, again, we have alignment and interest with our investors, same side of the table. We have a long-term outlook. Let the market come to us, like I said. REEPs work great with estate planning and inheritance plans. Heirs don't have to make any decisions. See, this is where we've had investors write into their trusts or into their wills to maintain this property for X amount of period with this company, and it makes it so the heirs just sit back and continue to get the cash flow despite an investor passing away. It's part of estate planning, and because of the way we structured it fits right in with estate planning. Let me keep moving because I wanted to get to some numbers. Here we go. Oh boy, that's kind of messed up. Yeah, I knew the formatting would be off a little bit, but so here's a typical REIT deal. It's supposed to be off to the left here, but a purchase price would be 95,000, rehab amount 20 grand, closing cost 1,500 bucks, and reserve funding of 3,500. So total capital required would be 120,000. For that, we're going to get a typical rent of 1,300. Actually, that rent has gone up. Monthly expenses about 40%, which would be $500, and that net cash flow $800 on that investment. How we chop it up, investors get 75%, managers get 25%. And this is pretty typical, rather than with a private equity company, which will do things like we get 1% to acquire it, 1% per year to operate it, and 1% to dispose of it. Then we give you 6%. Then we chop it up 80-20. We took out all the complexity and said, we're just going to do 75% 25%. And so the formatting is messed up on this. No, don't worry about it, guys. 1,300 in monthly rent, $800 cash flow, like we just said, which is 9,600, which means it's $600 a month. So $7,200 a year is going to the investor. That's the investor's portion of the cash flow. Now into the equity again, we the market value is 150, all in investment 120, investment. These are typical numbers. $30,000 in equity, which means the day that we close, the investor is sitting on $22,500 in equity, typically. Regardless whether this is the actual numbers or not, you get to look at the exact deal and determine, does this deal work for me? Is this enough equity for me to risk my capital? But try buying Apple stock at a discount, knowing that you're buying it at a discount, or at least being able to look at this and say, yeah, here are all the comps. That's another part of a REEP. We have a deal summary sheet which discusses, we believe that the house is worth 150, and here are the comps that justify that. We believe we can rent it for this amount. This is the comps that justify that rent amount. We think that the rehab is going to be $20,000. Here's what this is. Here's what all the rehab is going to go towards. So you come in eyes wide open, knowing what's happening with this investment before you get into it. So then every month you get a statement. Looks something like this. This is an example of that property on Camelot. You can see this investor snapshot. This was, we pulled this at the beginning of the year. I typically do proper market values at the beginning of the year, but I haven't done this one so far. This is one we bought last year, so it's kind of the same numbers: $150,000, $140,000 is what we think it's worth, and the investment was 115, so the equity started off as 25. But last year we collected $13,000 in rent, and so we go down and say, here is where the money has come in, here is where the money's come out. If you see the second page of this report, it's talking about anticipated expenses, but you can see in this particular case there's $4,053 left over that we're just holding in anticipation for future expenses. So this is one of the reasons why we're able to go without having capital calls. In fact, this month looks like we had $860 in maintenance that we had to do. Well, we're well prepared for that because we understand that there are future expenses. It's the second law of thermodynamics. Everything tends towards atrophy. So
And would
here's
you
the
say
growth.
that would
Oh,
you
go
say
ahead.
getting a property performance report monthly is pretty typical of a REIP, or is that something investors should be asking for going into it? Should they say, I'd like monthly updates, or what is your standard way to let investors know, where the property stands on a monthly or quarterly basis, or is that pretty standard?
That's what we do. Depending on how loosey goosey. Now we're a we're a a relatively large company looking to expand. If you're doing a onesie twosie mom and pop type REEP, I would at least look for quarterly financials because the financials can get out of hand real quick. The one advice I would give you is you have to maintain reserves. If you don't maintain reserves as an investor, you are the reserve. And so when something happens, you're the one writing the check. And so maintain those reserves. In that particular case, there was $4,000 left over. That's about right, because we just bought it last year. Some of our properties have larger reserves than that because we know the roof is going to have to get replaced, and you want to anticipate those future expenses. Now, of course, if it's a hail damage, you can have insurance claims, but I would suggest you knowing where the money goes. I would also suggest at least participating in reserves for what the future is going to look like, because property taxes are due every year, and if you're not prepared for them, you as the investor are going to be writing a check, and you don't want to do that. So back in 2017, we were buying deals with about $15,000-$20,000 worth of equity, and what we've seen is the write-up. We've also seen the cash flow go up at a steady pace. Like I said, ice cream melts, rent goes up. And so we've been able to kind of see. Now, that top line is going to go down, but that bottom line in single family houses, man, it rarely goes down. If you look at the history of single family houses, one of the reasons why I prefer single family houses over apartments. On my YouTube channel, I have a 3-part series analyzing apartments for single family. And so you may want to check that out. Why Memphis? Great market. I'll blow by this. Great market, good industries, job growth is still there. Cost of living is great. We've had no problems with Memphis. There's a bunch of corporate headquarters, including Amazon, just put a huge distribution center right next to about 17 or 18 of our houses, which we love. So who are REEPs for? REEPs are for investors looking to get their feet wet, student investors wanting to learn from the inside, seasoned investors wanting to invest in other markets. Maybe you want to dabble. Maybe you've been investing in one market and say, you know what, let me get into a different one. A REEP is a great way to learn the market, to learn new markets by participating in those markets. Smart investors recognize the importance of leveraging systems, and big league investors understand the value of their time. Now, I think I have more after this. Yeah, drawbacks to the REEP. So it's not all roses here. It's limited to cash flow markets. Okay, the price to rent ratio doesn't work everywhere. I think I already mentioned that. Leverage is prohibited because banks eat up the cash flow. I already mentioned that. But it's perfect for self-directed. Typically, you can leverage with self-directed, but it's the loans, from what I've seen, are so unattractive that it doesn't make much sense for investors. And so what we just deal with is cash deals. The purchase to cash flow time frame is usually several months due to rehab or occupants moving out. That's kind of an issue, particularly when investors have been used to the stock market where they put their money in the stock and now they can see it go up and down right away. You're going to have to be a little bit more patient with REEPs because what we're doing is taking a distressed asset and turning it into a cash flowing asset. It's not as liquid as stocks, but more liquid than REITs or private equity. We already discussed that. And deals are determined by market activity, and it may take longer than expected. I've got a waiting list of investors looking for deals right now. And so I am very particular about the deals that we get into, only B and C neighborhoods. My ideal house is a 1,500 square foot brick ranch in a B and C neighborhood in the middle of the block. That's what I'm looking for. But sometimes those don't come around as often. So we just got to be patient to get into the investment. But once you're in, man, stay in. Hold that thing forever. And then selecting quality local operators and crews. So that's the end of my presentation. I know you said we have this slide in here twice, but I do have a special offer for you guys. I wrote a book called Rollover to Retire, and it's a easy plan for real wealth. You can go grab a free copy of that at rollovertoretire.com. Also, we're going to be doing a market tour on February 20th. So you can kind of look at Memphis and see if it's a market you might be interested in investing. Just text Memphis to that number, 720-966-1929, and we'll get you all the details and see if it's something that might work for you. So.
Great, thank you, Brad. I had one more question I want to address because I think it's important. I know there's a few questions we didn't get to, but we did go over quite a bit, so I want to wrap it up for anybody that might have to run. But one of the questions was, are only accredited investors allowed to invest in REIPs? And I know you sort of addressed this at the very beginning, but for anybody that came in late, they're typically going to be accredited. Is that correct?
Well, no. I would say of our clientele, and we have some pretty high value clientele. Some of them are accredited and some of them are not. We do have, we have investors who have sold their companies or software, designers, or we actually have professional baseball players, people who play for the Chicago Cubs. It doesn't matter about, but then we also have some people who are, stay-at-home moms and, a bunch of different kinds of situations. It doesn't matter about the determination for accredited versus non-accredited is answering one question. And that question is, how do you know each other? Okay. If you know each other from being a friend or even a friend of a friend or met at a barbecue or your kids play sports together or whatever, you can get into REEPs without being accredited. But if the way you know someone is from a situation just like this, I speak to, REIA clubs across the country. If I get up on stage and I speak to someone, or if you put out an ad on Facebook, which I definitely do not recommend, but if you put something out saying, "Hey, looking for uh, investors," and someone responds to that Facebook ad, that's considered advertising, that's considered marketing, and in order for you guys to do business together, they have to be accredited, because if the way that they know you is from, if they were a stranger before you were talking about investing or soliciting for investors or whatever, then that then they need to be accredited, and you had better make sure you put a private placement memorandum, because the rules in breaking that are crazy. Not only are you going to be dealing, one of the clauses with SEC is that you would have to pay back the entire investment. So if someone puts 120 grand in, if they're not accredited and you didn't disclose it, you don't have a private placement, you may have to pay that $120,000 back to them, plus whatever damages that has been caused from a legal perspective. I mean, you're talking massive things, and that's just on one deal. If you did it over the course of several people, you got a problem. The second thing, though, is um, if you're advertising, uh, if someone comes to you as an accredited investor, that private placement memorandum scares the crap out of everyone, because it's basically telling everyone what everyone should know, but the SEC wants to make it super clear. This is investing. It can be dangerous. You can lose all of your money. You may not make anything. We don't know we have it. We are experts. We think we got a shot at this thing, but man, we don't know. And that's what that private placement does. It protects you as the manager. It actually protects everybody involved, because um, an accredited investor, according to the SEC, is someone who knows the risks of investing, whereas that person who, is not accredited, they're considered unsophisticated. That doesn't mean that they can't get into a REEP. All that means is they can only get into a REEP with someone that they know. So a friend of theirs, a friend of a friend, a family, something like that. Now, it does make it more difficult. There's so many layers to this. It does make it more difficult, like Larissa was talking about, of qualified people, because you may not be able to use your retirement funds. You aren't allowed to use your retirement funds to deal with, a brother or a dad, or, like I, I don't know all of those rules as well as Larissa does, but that is a different set of issues. That's an IRS issue, whereas a REEP is dealing in the security world. So simply put, answer the question: how do they? And and an SEC attorney will help you out with this. But um, how do you know each other? If you're friends and family, you still need to put the paperwork together, but they don't need to be accredited. It'd be a 506B. If you know each other because of, you know, marketing or advertising or even teaching, then you need to put together a 506C, private placement memorandum. So,
Okay. Well, I think with that, we're going to wrap it up, but that was great information. Thank you so much, Brad, and thank you for joining us. I really appreciate it.
thanks, Larissa. Anytime. This is great.
And everybody that's on, just so that you're aware, this is being recorded, and the recording will go out to you since you did register for it. So if you wanted to listen to it again, review it, or maybe even share it, we appreciate that. If you have any questions for me, please let me know. If you have any questions for Brad, you're welcome to reach out to him. And how do they get a hold of you? Is your website the best way?
Website's a great way. That phone number, 720-966-1929, gets to me too. You can
Okay.
text or call that one. But
Okay.
yeah, it's a great way to get a hold of me.
Okay, great. Thank you so much. And thank you, everybody. We hope to see you again soon.